it's Laura. So I put out this video around the same time last year, and to this day I get quite a lot of questions about it, either in the comment section or people reaching out to me directly. And what I've realized is that I was getting asked the same 6 questions quite frequently, so I decided to make this video answering those 6 questions in hopes that it's going to give you a lot more clarity about how the strategy works. Okay, so here we go. The first question is, how do you use a credit card to pay for a mortgage? You have to use either the balance transfer checks that come with that credit card or the cash advance feature. Now, you can link that credit card directly to your checking account through overdraft protection. The only downside is that not every single bank will allow you to do this. And for the banks that do allow you to do this, they want you to link a credit card that they offer, right? So they have a couple of options. You can either open an account with them, or maybe you have a credit card already with that bank, so you have to use one of their cards. Now, the reason why this may make this process more convenient is because you can keep making loan payments just as you had before, stating that payment is going to come from your checking account, but if you follow the strategy says that you have to move the money from your checking account into your line of credit. So when the payment tries to process, overdraft protection will kick in and that charge will get made to your credit card. Now, on the transaction side, statements with the credit card, that transaction is going to show up as a cash advance. So there's a couple of things that you have to look out for, and that's the fees. And there's technically 2 fees you have to look out for. First, you want to make sure that the checking account itself is not going to charge you an overdraft fee every single time that you use that overdraft protection feature. The second type of fee is you want to be aware of what the cash advance fee is on the credit card side. Now, with the checking account overdraft fee, you can most likely avoid that because, for example, I bank with PNC Bank, and I know that they offer 3 different checking account types. 2 of them do not charge any overdraft fees, and I believe that the first type does charge an overdraft protection fee. You want to make sure that they're not going to charge you that fee on the checking account side, or if you already have an account that allows you to put this feature in place, you want to make sure that you either switch a checking account type so that it doesn't charge you that fee, because the cash advance fee on the credit card side, you most likely can't avoid that fee. With all those fees, you want to make sure that you calculate them into the total payoff plan so you take account of it. Now, I know that I mentioned PNC Bank, but I'm not affiliated with them in any way. It's just simply the bank I use, and that's the process that I go through. So I'm very much familiar with how PNC Bank works. And it doesn't mean that it's the best bank. It's just you do your research and you find out what works best for you. You find out what type of credit card works best for you, how you can access the funds, what type of way of accessing the funds is going to work best for you, and just use that way. I am going to share the process of making the analysis when you're picking the credit card. So I know that PNC offers 4 different credit card types. So whenever I'm analyzing the potential credit card that I'd like to use for the strategy, I would analyze it from the filter of this strategy. And what I mean by that is that you want to take a look at all of the fees. You want to be aware of those. Of course, you want to use the card that will offer the lowest interest rate. Also, you want to take a look at the type of card that it is in itself, and if it's going to offer some great cashback incentives, some rewards points, maybe it's going to offer some great miles that you could track and then exchange it for great airplane tickets. So it all depends on your lifestyle and what you're going to use most. Question number 2 is, what happened to the interest? In this video, I'm going to give you all the details to help you understand how the interest plays a part in the strategy. I actually created a spreadsheet that is going to represent the credit card statements for the full 6 years until the mortgage is paid off, and that statement is going to include the interest and all the credit card fees. Here we go. Let's take a look. To create this credit card statement example, I went off of that Visa Premier Traveler's credit card, kept all of the figures in place from my first video, which basically considered that the credit card had a $15,000 limit, $12,000 cash advance limit, and it charges us a 21% interest. Now I know that cash advance interest may vary from regular credit card interest, but just for simplicity's sake, I am just assuming that it's 21% for both the regular credit card purchases as well as cash advance and balance transfer. So I'm considering everything as if we've had this card for a long time and there are no sign-up incentives. The only thing that I am taking into consideration are the 1% cash back. The way you read this chart is that each one of these columns represents in its own month, and the numbers on the side here represent each individual days in the month. But basically, I just put in all of the expenses in red. And of course, in real life, there are fixed expenses, and the fixed expenses are the mortgage payments, which always come on the first of the month, the car payments, which come, I just assume, on the 13th of the month, and then the utilities, the phone bill. Of course, you may have some other fixed expenses, but this is just an example. And then all the ones in green here represent the cash flow. So that is basically the day you got paid and the money was transferred into your checking account, and as soon as it hit your checking account, you would log in online and make a payment towards your credit card. You would pay the credit card on that same day. You would move that money in. It's all about the movement of money. Yeah, so as you take a closer look at the end of the month, when all of the living expenses were charged to the card, I would use the cashback rewards and just apply it towards the card to reduce that balance even more. So when you take a look at the bottom here, it's the end of the billing cycle, and that's the equation that credit card companies use to calculate how much interest they're going to charge you. So the key in this equation is the average daily balance. And as you see, the reason that this strategy calls for moving your money over from your checking account into a line of credit is that when you move the money over, you see that on day 1, the credit card balance was almost $1,200. On day 6, it's only $40. And then on day 22, it's $9,605. And then on day 31, it's $10,000. So we're getting charged interest on $40 over here, $0 over here, $10,000 over here. So the way that they figure it out is they get the average daily balance by adding up all the different amounts for the total balance that was carried on each day and then dividing it by the number of days in the month, which is the equation is down here. So that is the total interest that we paid for the first month. Now, I know some people were asking, why would you want to use that credit card for everything? Why not just use this credit card once and just put the $12,000, which would go towards the principal pay down? Right? So why not just take this and apply it on day 1 and then just pay the extra $2,000 on the due date whenever that payment is due for this card, and then not have to worry about any of this? Well, the reason that this strategy calls for using this credit card or this line of credit account as a checking account is that by this movement of money, you capture the interest savings. Because if we just did this $12,000 on day 1 and didn't use this card for anything, the average daily balance for every single day would just be $12,000. So the interest would be around $200 for this first month instead of $83. So basically, when you have the interest identified, then the total balance is basically whatever the balance was left over from that month would add interest, and that balance would carry into the next month along with cash advance fee. And then in some cases, once I hit that cash advance limit, I would have to use balance transfers right here. So I have the 3% balance transfer fee. At the end of the 6 years and 2 months is when the mortgage is paid off in full. And over here, I listed the total interest and total fees. So that's something you want to take into consideration. And Question number 3. Why not use your savings to pay off your credit card and or car loan, then reduce how much money goes into savings and have the same amount going towards the principal paydown directly without the hassle of having to deal with a line of credit? It is much safer, and for emergencies, I don't carry any balance on my credit card, and if I do need access to money, I can access my credit card then. So the reason you would use a credit card or any type of line of credit is, as I would summarize it in my own words, that there are really mainly 3 benefits that you're getting from using a credit card. So benefit number 1 is cash flow. And what I mean by access to cash flow is, if we take a look back at our credit card statement, on month 1, we're able to apply $12,000 towards our principal of the mortgage. Now, if you were to do this with cash, you wouldn't have access to that money because you wouldn't have $12,000 in cash. So that credit card really does give us leverage. Now, benefit number 2 is time. You are able to pay off debt much faster and build your equity position much faster. And benefit number 3 is that you're able to save money, because if you were to go the traditional route, you would have to pay so much more in interest, but because you're leveraging a line of credit, you're able to save a lot more money that you would have had spent otherwise. To run this scenario and compare using a credit card versus paying $2,000 cash towards the principal of the mortgage, I plug these numbers into amortization calculator inside of Excel. I created the different tabs basically to compare. This is the loan information without applying any extra payments. This is the information for using the credit card as our strategy suggests. So the extra payments are $12,000 every 6 months. And because of the interest, and if you analyze the credit card statement spreadsheet that I shared with you, you can see that we're able to apply $12,000 on month 1, then month 6, then month 12, which is every 6 months. And then we're not able to apply it on the 6 months here because of the interest. It would have to roll over to month 19. So that is how this would play out right here. And this is exactly just how the credit card statements also reflect the same timeline. And we're basically looking on this amortization calculator, the loan summary. You see that the actual number of payments was 74, which also results in time being 6 years and 2 months. And that results in savings of $192,728.39. I also created the spreadsheet for making extra payments of $2,000 in cash towards the principal of the mortgage. These are the results right here. And that results in 76 payments until the mortgage is paid off. So that is the difference of 2 months. And the savings, so it seems that we hit every single one of the benefits using a credit card. We saved on time, we saved on savings, and we created cash flow as a result of paying off this mortgage faster, and we had access to cash flow. But did we really hit all of the benefits? Because if you remember, I pointed out that at the end of the 6 years and 2 months, we still had paid total interest for the credit card as well as the fees. So we're actually not hitting benefit number 3, which is savings, because it's actually costing us money and we're actually losing money by using this credit card until the mortgage is paid off. So what does that mean? Does it mean that this is a bad credit card that I picked? Or does it mean that the strategy doesn't work? No, all that it means is that you have to find the break-even point. And what I mean by that is you have to calculate, okay, at which point over here did it no longer make sense for me to use this credit card, where actually paying in cash was saving you more money. So if you scroll all the way over here, I already calculated that about 3 years and 2 months in, using a credit card is actually saving you more money than using cash. And you can compare the difference here. The savings and savings here. So you're actually saving a lot more money by using this credit card. And on month 45, which is June 2022, is when you actually begin to lose money for using this credit card, because if you compare, I wrote the cash comparison here, the savings in interest is this much, and then the savings using the credit card is this much, but the total in fees and the interest combined outweighs the difference in savings. So that is basically the break-even point around this time frame. That is what you have to figure out with any type of line of credit account you're going to use. So what does that mean? Does it mean that at the end of 3 years you just have to switch to cash and pay off the mortgage in cash? Not necessarily. What this strategy is all about is getting those 3 benefits. In that 3 years time, you know that you can either improve your credit score, improve your debt to income ratios, you're actually building equity in your property. So after those 3 years, you can actually, most likely, if you work on your finances and your credit scores, you can qualify for better line of credit products that can save you more money. And that is if you don't use a different line of credit product right from the start. Even with this high interest credit card, for 3 years, you can use it and still save a lot more money, even with the fees that you're paying, rather than just paying in cash. That's the whole point of me making this video and me sharing with you. That brings me to my 4th question that I get asked quite frequently, and that is, why not save up to $12,000 over the 6 months in a savings account, let it grow in interest, and pay more off and not have to pay interest on a line of credit? Now we have another scenario and that is, why not leverage a savings account? So we have $2,000 in cash flow left over every single month. Why not take it and put it in a CD, let it accrue some interest? So my first question is, what kind of rate of return can you get? Let's say you get really lucky and you're able to get a 2% return on your savings account. Let's do some math, and I'm going to jump over to this website. And if you are thinking about this scenario, let's compare the results. So as I mentioned earlier, let's assume that you're going to be getting a 2% rate of return, and you can run the numbers for yourself. And I'm just using a bankrate.com calculator, and I plugged in all of the information. Of course, the starting amount would be 0 because on month 1, we're really thinking about doing it this way with a savings account, and years to save, you can't do this by month, so I'm just going to say 1 year, and additional contributions would be $2,000 per month, and all of these details are right here. So now I'm just going to click on view report, and you can see the amount of interest you are earning month by month. So month 6, we've actually accrued $70.19 in interest. So after those 6 months, are we really getting all of that $70.19? No, not really, because sometimes there's fees, and of course nobody can avoid taxes. Because this interest right here is actually considered earned interest income, it is going to get taxed at a rate of close to 50% for earned interest income. So this $70 looks more like $35. So that is what I am going to consider when plugging in this information into an amortization calculator to see the results on month 6. So every 6 months, we're applying this amount. So the results would be that it would actually take us 78 payments, which would result in 6 years and 6 months, and a total of this much in savings. So to actually see all of these results and a comparison side by side, I actually created this table which compares the 3 different scenarios. So this column represents the different strategy, and each section of this strategy going this way represents the benefit. So as you see, this is benefit number 2 time. Using a credit card, you do pay off the mortgage faster. This is benefit number 3, savings. This is the difference between paying cash, and this is the difference with using the savings account. And then this is benefit number 1, cash flow. You do get cash flow. We're paying the mortgage off 2 months sooner. We're creating $2,000 in cash flow. And here, this is a difference of 4 months. So we're creating nearly almost $5,000 in cash flow. So that benefit we're hitting. So this is the total cost, $11,000, almost $500. So that is why we lose out on the savings portion over here. I just have this comparison down here as well, but we already know that it's important to find the break-even point and get a little more sophisticated with the strategy. The cost of using cash is right here, and then the cost of using a savings account is right here. So it's a totally different mindset when it comes to this strategy, because a lot of people think, well, if I just use my own money, if I use cash, there is no cost to it. I don't have to pay interest on it. There's no fees. And the same with the savings account. It's your cash plus some. And the cash flow creation here is the total interest over the 6 years results in $456.23. So by storing your money in a savings account for 6 years until the completion of this strategy, taking it out every 6 months would result in this much earned interest income after taxes. Oh yes, going back to the cost, there is a cost to using your own money, because compared to this strategy, you're losing 2 months time and you're losing this much in potential cash flow. Same with using a savings account, you're losing 4 months of time and you're losing this much in potential cash flow. Question number 5, where did I learn this? I actually took an online course that came out to being about 12 hours long. And the course is divided into 2 classes. One is called Velocity Banking and the other is called Advanced Velocity Banking. First class, Velocity Banking, which is essentially what the strategy is called, goes over personal debt, personal finances, and implementing the strategy with a personal home, any type of personal loans. And the second part of the class, Advanced Velocity Banking, really goes in depth on using the strategy on the business side and using and leveraging the strategy to really accelerate the rate at which you can build your investment portfolio. If taking this course is of interest to you, I will leave more details about it right below this video and you can take a look. Question number 6. I live paycheck to paycheck, do not have savings, and this is just unrealistic for people making less than $5,000. So this is not so much a question but a statement, and I did get quite a lot of these types of comments. So what I'd like to say to you is, if you're in a tough financial situation and you may have seen this video and thought, okay, this is great, but can it really work for me? The scenario and the figures that I used in my video is simply to illustrate how the strategy works. The income does not determine whether the strategy is going to work or not. What is going to determine is the cash flow. So my suggestion is, if you are living paycheck to paycheck and your cash flow is 0 at the end of the month, is create a budget to really identify where is all of your money going. So once you do that, then I encourage you to try and find $100 within your budget that you can have in cash flow creation. It may feel so insignificant, like it can't make a difference, but with this strategy, I promise you $100 goes such a long way, and it can create such a bigger impact than you could have ever expected. And then if you're really thinking about implementing this strategy, take the course to really fully learn everything about this strategy. If you did watch my video all the way, thank you so much. I hope you found it very valuable and that it's going to help you. If I did not answer your question and you still have some questions, just leave them in the comments and I will get back to you and do my best to help you out. And if you found this video helpful, just be sure to leave me a thumbs up, as I would really appreciate it. Subscribe to my channel to get more of my videos. And I will see you in my next video. Thank you so much and have an absolutely wonderful day.